Hello and welcome to the Laugh When the Market Crashes podcast. And this is formerly the We Money Talk, which was Wealth Education Money Talk. We have rebranded it to coordinate with a new book that is coming out shortly called Laugh When the Market Crashes. And this is a podcast that's going to go over how to deal with and control with the primary risks and opportunities that are presented in investing, tax, and estate planning. So we thought the inaugural episode should be on that very subject. So today we're going to talk about understanding the risks you face in investing. So let's roll up our sleeves. Grab your favorite beverage. For me, I'm enjoying a nice hot cup of coffee because I usually record these early morning. And let's jump right in and talk about the risks an investor takes. So we're going to address these one by one. They are all very important. So I started to do a top 10 list, and I quickly realized it's really hard to rank them because they all need to be addressed properly. So we're going to go in no particular order, and we're going to start with one risk that I think can really hurt people when not controlled. And that is the behavioral risks that are inherent in investing, meaning letting your emotions control your decisions. So we often talk about FOMO, the fear of missing out, where people will see a market that is on fire and they haven't been in it, and they finally just have the pain of not participating cause them to get in. And they often get in right near the top of the market when it's about to crash. So you need to be a disciplined investor. Do not let emotions control your investment decisions. If you have a strategy, you have an approach that you've studied and is academically based, you need to follow it, even if maybe at times it is lagging what somebody else's approach is, because that's usually because they're taking on a much higher level of risk. So behavioral risk is real. And I will submit that this doesn't just affect clients, it affects the advisors. So having something that is very systematic way or method of investing, such as defined outcome investing, which is what Laugh When the Market Crashes book is all about, it will improve your performance. So you got to control those emotions. Now, let me give you a good example. 2008, when the market is crashing, it's down 55%. Real estate begins crashing also, and everything is on sale, but it feels like this time is different. It feels like it's going to keep going down. People start giving up. People are losing their homes. People have lost their portfolios. As Warren Buffett would say, blood is in the streets. That is when you buy. Now, the challenge is your emotions are going to say, don't buy, protect yourself. We as humans, we have a fight or flight mentality. And when things are crashing and things are that bad, a lot of people submit to flight. And that's the worst thing you can do. So I would say one of the single biggest risks to your portfolio, understand why you're investing, or make sure your advisor at least understands and they're disciplined enough to stick to it during good times and bad, because ultimately markets are a cycle, and ultimately a good strategy should play out well in the long run. You just have to stick to it and control those emotions. So that's going to be the first risk we're going to talk about. Now, the next risk I would say is more a mismatch of your goals, your time horizon, and your risk tolerance versus a portfolio. So what I mean by that is a portfolio that's good for one person is not necessarily good for the other. And we see this all the time where you see some, let's just take two portfolios. They're both $2.5 million. Client one, this is their IRA. They have Social Security and their IRA, and that is it. And then they've got their home, their real estate and stuff. But their sole source of income is going to be Social Security and that IRA. You're going to manage that portfolio very different than another client that has the same exact portfolio, same net worth, but they also have a pension of 15, 20,000 a month from their employer. Those are two very, very different portfolios. Now, if you add another thing to the equation where maybe one is 50 years old and one is 70, that's going to change things also. You have a different time horizon. So a lot of times people have made it, so to speak. I mean, they've made their goals, they can live their ideal retirement, but they're still in that mode of chasing the highest return they can. And they're taking the eye off the ball as to just how much risk they took to get there. And maybe it worked out for them, but that same risk that can cause a skyrocketing portfolio can also cause it to crash and burn. So we often used, I believe it was Oracle stock, or maybe it was Cisco. I need to pull up that old study. But this was back in the 2000 era where it showed this stock going straight up, very much like Tesla stock today, not to pick on Tesla. But then you look at the next 25 years and it dropped like a rock and has never recovered. 25 years. So you can't just chase the latest high risk investment if your time horizon is you're in the sprint to retirement or retired. You can have a proper exposure to it, but you can't have a concentrated position, which is how many people build wealth, but it's also how wealth is destroyed. So mismatch of goals, risk tolerance, and time horizon, critical to control that risk. So that's number 2. Now let's look at number 3, which is a risk that is the single biggest fear to most retirees, and that is longevity risk, or the risk of outliving your money. Now, this really correlates to how is your portfolio designed and what withdrawal rate should you take. So it used to be that it was around 4.8% withdrawal rate was safe. Now it's sub 4 because volatility is so extreme. So let's just call it a 4% withdrawal rate. If you're taking out a 4% withdrawal rate, you're probably safe even in a plain vanilla 60-40 stock bond portfolio. But if you build a better portfolio with defense, some of the concepts we talk about in defined outcome investing, the back testing shows you could go as high as a 6 to 7% withdrawal rate. Now, do we recommend you do that? No. We use 5 as we model, but we're very comfortable with 5 the way we model. Now, if you do a 60-40 stock bond portfolio, knock that down to 4 to be safer. But the key of the risk of outliving your money is people are living longer and longer. And if the statistical life expectancy is 85 and that's what you're planning for, but instead at 85, not only are you still alive, but you're still in your go-go retirement years. You haven't even hit what I call the slow-go retirement years yet. You're going to be in a world of hurt if all you have to live on is Social Security. So you want to make sure that you create your portfolio as a plan to live portfolio, not one that you have to die to make it work. And with adding some defense to your portfolio, it's easier to do than you think. So I think the risk of outliving your money is a fear and a risk that is real out there, not hard to control if you do it thoughtfully, but it's very important that we address it. So that is risk number 3. The 4th risk is somewhat related. It's sequencing of return risk. So what does that mean? Well, let's say you're withdrawing at 4%, but you retired in the year 2000, right before the technology crash. And then you were there for the recovery. You're withdrawing all this time. So you're taking money out that can never recover because you're living on it. The market recovers into 2008. You're feeling good again. Then the market crashes another 55%. Well, if you had a pure stock portfolio in the S&P 500, you will lose, the studies will show about 65% loss of wealth during that time frame if you're withdrawing at 4%. 65%. Now, that means you only have 35% left. It's not going to be able to recover and protect you in your retirement, and your portfolio is likely to implode at a 4% withdrawal rate. Sequencing a return risk to some degree is dumb luck, but not completely. So ask yourself this right now, whenever you're listening to this, are the markets on an extended bull market run? So we're closer to the top of the market than we are the bottom, or have the markets just crashed and we're closer to the bottom? If you're retiring now and the market's just crashed, you're probably retiring at the perfect time if your portfolio was protected and ready, meaning it's probably going to do well over the next 5 or 10 years. But if we're near the top of the market and you retire and the market drops 40, 50%, or the tech sector dropped almost 80% in the early 2000s, that could be devastating to your retirement. So you've got to design the portfolio to be ready for that crash. So we called the book Laugh When the Market Crashes, and now the podcast, because if you're ready, you're not going to be laughing out loud, but you're going to have kind of a quiet smile come to your face because you're going to know you are ready, you're protected, and your portfolio is designed to have some protected positions mature and buy the dip. So you're about to make a lot of money. So sequencing a return risk is something that you can harness to be a benefit for you, or you can ignore it at your own peril. So we got to address sequencing a return risk. Risk number 5 is concentration in a particular investment asset. So think of NVIDIA, high flying stock. If you had all your money in NVIDIA for the last 10 years, you have made probably millions and millions of dollars. Wealth in America overwhelmingly is built by owning a business, which a concentration in one stock is very similar to owning a business, and by real estate. That's about 80-85% of people who have wealth. That's how they built it. Not by getting a paycheck and saving monthly into your investment account, although that's important, but that's not how big wealth is built in America. Concentrated positions and real estate. Now, a concentrated position, though, when you get into the sprint to retirement or retirement, as much as it helps build wealth, it also destroys wealth. So there are multiple studies as to how many businesses make money and last. The vast majority of them fail. So most entrepreneurial ventures fail. So if they fail, that means your investment could go to zero if you have a concentrated position. But it's not just current companies, it's established companies. Think back to big names when you were a child and how many of them are not even around anymore. So you've got to be careful having a concentrated position and sticking to it. When you're younger, it's one way to build wealth. A lot of times you're working for a tech company and you built a lot of wealth that way, and you're investing in competitors, and that's still a concentrated sector. And then when you retire, if you just keep doing that, it could mean that you are going to be going back to work someday if the markets crash. And if you have an experience like we did in the 2000s, where tech dropped 70, 78, 79%. So concentrated risk of assets is a risk you've got to control and diversify in order to control that risk as you get to retirement, which means probably lower returns versus a high flying stock, but a safe retirement. Now, a related risk, the next risk we're going to hit on, number 6, is concentration of strategies. And we see this all the time. So let's just take stocks as an example. I will say the vast majority of people that come in, we see that their only strategy for stocks is what we call naked in the market, meaning none of their stock strategies have hedges or protections when the market crashes, which will allow them to get out up here and buy the dip. So the idea is to get out near the top of the market and buy the dip. But if you're just on the roller coaster ride and you're just buying Vanguard or stocks, you are going to get crushed along with everybody else in the market when the market crashes. And it will crash. Markets are a cycle. So it's just a matter of when, not if. Typical retiree will see 3 to 5 major crashes during their retirement. So concentration of strategies is an important area to address. So stocks, again, as an example, we recommend people do have that naked in the market sleeve for their stocks, but we also get stock exposure through what's called a capped and buffered strategy, where maybe we're accepting only 16% of the upside, but in return, maybe we're eliminating 15 to 20% of a crashing market. So the market's down 30 and we had 20% protection. We're only down 10, and then we get to buy the dip. So as everybody else is getting back to break even, we are making money. Target strategy is the third one. That's similar, where maybe we're targeting 80% of the upside, or 60% if you're really conservative, of the upside of the market. But in return, if we're getting a break even year to year, markets crash 50%, we get a zero because we got out break even, but then we get to reinvest. And if the markets are down 50%, we're buying stocks when they're on sale. This is the magic sauce of how you create a good stock portfolio. So you're doing it by adding 3 different strategies, and we can add a few more, but those are the 3 primary core strategies for stocks. The same applies for fixed income, where you don't just want to rely on these crummy, low-yielding bonds. They're needed, but there are other fixed income sources that can increase your returns. So you need to diversify your strategies as well as your stocks. So I think most people understand you got to have diversification of stocks, but you should also have at least 3 strategies as to how you invest in stocks. Next risk is liquidity risk. So liquidity risk is a risk that can work for you and against you. So liquidity risk, let's just take a classic example of a rental property. A rental property can be a great cash flow. Maybe you're making 6 to 10% just on net rents after your expenses, but it also has a growth component, because if in California, let's say real estate goes up on average around 3%, not only are you making your cash flow, let's say it was 6%, but you're also making the growth of the real estate. Your net worth is increasing by 3% a year on average if real estate is going up in value. Now, if you have debt, let's say you put down 20% on this piece of property, and let's say you're cash flowing at 6%. If the markets go up, meaning real estate increases by 3%, you only have 20% in that property, and it went up 3%, but you get 3% on the entirety of the property, not just your 20%. So basically, you get a 15% increase of value on the 20% down payment you did. So I know that's a mouthful, but that's how you build wealth in real estate. And of course, when real estate drops, it cuts the other way too. So the key thing when we're talking about liquidity risk is that's a great asset. But if the markets have crashed and there are no buyers out there, you can't sell it and get your money when you want it. So you have what we call liquidity risk for non-traded assets, because sometimes you can't move them when you want. And oftentimes it's not wise to move them at that point because things are on sale, meaning markets maybe have crashed in that sector. So liquidity risk can both, it's not something to avoid. It's something to have the right proportion in your portfolio, because it can increase your returns while decreasing your risk. But it's a different type of risk that you don't want everything in a category that has liquidity risk. So again, diversification is important. Risk number 8 is inflation risk. Now, inflation is something that's been in the news a lot, primarily. Sorry, for a moment there, I thought I stopped the tape. So primarily, it's been in the news a lot because we've had all of these tariffs. And the thought is, are tariffs going to cause inflation? Well, without getting into tariffs, let's just talk about the inflation risk that they're worried about. If inflation is running at 3%, that means every dollar you have in the bank, if it's not earning at least 3%, it's not even keeping up from a purchasing power standpoint. So inflation is something we talk about real returns. A real return is how much are you earning over and above the inflation rate. So if inflation is 3% and your bank is paying you 1%, you're losing 2% a year. If you're in a bond making 5% and inflation is 3, your real return is positive 2. You're keeping up with inflation plus growing your purchasing power by 2%. So inflation is something we absolutely have to consider as we're creating a portfolio and have assets that will properly combat that. Assets like equities are classic long-term inflation hedges. Real estate, classic long-term inflation hedge. So in the short term, there can be volatility, but long-term, they do quite well. Now, there's a number of risks, and I'm just hitting on a variety of them. But the next risk I would say that is oh so important is taxes and regulatory risk. Now, these are actually kind of two, but taxes, if you can imagine investing into a market that you know you're going to lose 30% next year, would you invest in it? And most people would say absolutely not. Well, if you're in a state like California, you could be in a 30 to 50% tax rate, which means every dollar that you invest, 30 to 50% of it is going to go away if you're not doing good tax planning to the IRS. So taxes are a massive drag on your portfolio. And when I say massive, the difference between controlling taxes and not controlling taxes, for somebody that's saving, let's say $50,000 a year for the 30-year investment career, you're going to be talking about millions and millions and millions and millions of after-tax dollars for those that do it right versus those that do it wrong. And I'm not over exaggerating. The difference between doubling your money, let's say you're at a 40% tax bracket and you're earning 10% return. That means you're doubling your money every 7.2 years if you are in a tax-free investment. So if you have $100,000 in 30 years, what I say, you're going to double your money every 7.2 years. So in 30 years, it's going to double about 4 times. So 100 becomes 2, then 4, then 8, then 1.6 million. If instead you're losing 40% to taxes, you're only making 6%. So you're doubling your money about every 12 years. So 3 times. So instead of 1.6 million, you're going to have about 800,000. Now I'm just giving you rough numbers right off the top of my head, but it illustrates the point. Taxes cost you half of your money in that hypothetical. 1.6 million versus 800,000 for the identical investment. Just one had taxes, one didn't. So proactive tax planning is a centerpiece of how we plan. It is absolutely critical. Now, the other risk I mentioned is regulatory risk. This one, a lot of people don't think about, but we do a lot of lending in our practice and we like real estate and other things. You've got to pay attention to regulations. There are some states that they will, in times of stress, they will choose the winners and losers. Now, we happen to live in one of them in California. And there are other states that are more free economy. So you've got to be careful of regulatory risks. And when you invest in things like real estate, you got to place them in areas that there are lower regulatory risk. Regulatory risk can also be something like raising taxes in the future. So right now we are at fairly attractive tax rates. A lot of us are locking those in through Roth conversions and things of that nature to make sure our taxes are effective. And we're doing it with tax planning. So the goal isn't to pay 100% on this Roth conversion, it's to have it discounted. What if taxes are at 39% instead of 22% when you retire? That is a huge impact on your retirement. So we need to look at taxes and the regulatory framework and what might happen in the future. It's a big risk in your portfolio that you've got to address. So hopefully you enjoyed this list of 10 different risks. It is not all of them, but it's some of the primary risks along with volatility, which we kind of indirectly hit on as we went through this, meaning market fluctuations you need to be ready for. Perfect world, you're paying no taxes. You're buying the dip every time it crashes, and you're not the least bit stressed the next time the market crashes 50%. You're just living your best retirement life. So we want to help get you closer to that goal. We can get you closer. There is no magic bullet that eliminates all these risks, but we can help eliminate them for you. So hopefully this was helpful. Make sure you address and employ them in your portfolio. And hopefully you've rolled up your sleeve, enjoyed your cup of coffee like I have, and hopefully you've gotten some value out of this podcast. So please like us, follow us, share us. Thank you very much for joining us. And I want you guys to have a wonderful day. And we look forward to seeing you on the next podcast to share more ideas as to how you can benefit in your portfolio and how you can be ready. So the next time the market crashes, that quiet smile comes to your face that I referred to in the book, Laugh When the Market Crashes. So thank you and have a wonderful day. I'm Terry Wheeler. We'll see you next time.
Thank you for listening to Laugh When the Market Crashes with Terry Wheeler. Be sure to click the subscribe button to be notified as new episodes become available.